Welcome back. Now, all eyes were on the SARB's MPC meeting today, and as expected, the MPC stood pat on interest rates. Frank Blackmore, lead economist at KPMG South Africa, that is, joins us now with his reading of the outcome. Frank, thanks so much for your time today. Now, while it was expected, the split quite interesting, with 4 members voting for a hold, while 2 voted for a cut. Does this indicate that there is more room to cut rates?
I think there's obviously room to cut rates. If you zoom out of the problem the governor keeps expressing is that he wants to see expectations for the inflation moving towards the guidance that he's given, that 3%. So the lower part of that 3 to 6% band is now target. He said there has been progress in terms of those expectations, which I think at the last survey came in at 4.3%. So that's below the previous target of 4.5, but I think still far too high for what he needs in order to start reducing those rates. So once those expectations come down, we can expect more rate cuts.
And I wonder if those expectations will come down even further. I mean, even the governor spoke about this. We are dealing with really high administered prices, which is also filtering through to that headline inflation number.
Yes, if you look at the components of inflation, I think your households contribute 1 percentage point to the 3 point whatever it is, and that's terribly large component of inflation at this point in time. That's largely driven by, yes, your municipal costs, electricity, water, such, and other administered prices. But the final one has been well behaved, and that's of course oil and fuel prices, where we've seen those remain relatively constant globally, but the strengthening of the rand has allowed for a reduction even on that transport type of inflation. So you did right in that aspect. Once we get those costs under control, we could see even lower inflation. But remember, an economy needs a certain amount of inflation in money to be pumped into the economy under activity. We would like to see the economy experiencing in some point in the future sort of excess demand out there as businesses, people look for the same goods and services in the economy and bid those prices up, because that's a good sign of a healthy economy and growth in that economy. But we're not seeing that at the moment. It's more of a cost push type inflation, as you said, through administrative prices.
And talking about the economy then, Frank, what I found shocking was the SARB actually increasing its outlook for growth for 2025 up from 0.9% to 1.2%, and this following a better than expected GDP print for Q2. Is that achievable, right? I mean, yes, we are noting somewhat of an uptick in GDP in Q2, but then when you look at some of the prints that have come out for Q3, manufacturing in particular, the July print quite downbeat. Sentiment is also not really upbeat. So I wonder if we will even be able to achieve a growth of over 1% come year end.
Well, I think obviously time will tell.
Yeah.
I think our expectation is still for around the 1% or just below. And one of the other reasons that came was the legislative changes that came into last year with that two-pot system, allowing a large release of money to be spent, helping boost growth in Q3 and Q4 of last year. Well, Q3 this year, now there's no new stimulus flowing into the economy in Q3, and therefore we expect perhaps a more muted growth in the bank is seeing at this point in time. But what he doesn't share are all of the assumptions underlying. He does share a certain number of those assumptions, specifically if you go to the forecasts made in terms of the MPC. They put a lot of detail down, so Is it possible? Yes, it's possible. Of course, it's possible. Where it will come from, well, we don't quite know yet because we don't think it's going to be there. It would have to be consumption-driven then, or investment-driven, and investment particularly is very sluggish, and consumption has performed relatively well. But as you say, there's certain pockets of concern still in the market, and of course, there's a lot of uncertainty in the market as well after the Trump tariffs, geopolitics. So that's the global situation as well as locally. What changes are going to happen locally that would boost economic growth in the Q3 and Q4? The type of changes we need, infrastructure, etc., would take a lot longer to have an effect. But if sentiment was raised and consumption increased, that accounts for about 60-65% of our GDP. That could help lift GDP theoretically above that 1% level.
Now, Frank, we are a year into the SARB's cutting cycle, and rates have been reduced by 125 basis points. Let's talk about the impact and how or whether it has actually started working itself into the economy. We do know that those cuts do take up to 18 months to actually filter through. Well, between 12 and 18 months.
And I think there was a similar question to the governor in question times after his presentation. And basically the governor was saying that each of those have a delay. So it's sort of like waves hitting a shore. The first change hits, then the second change, then the third change. But in a system where nothing else was changing, deteriorating or improving, it should have a beneficial effect on the economy. It has lowered rates 125 basis points since September last year. That's made borrowing more accessible and more reasonable, and that should stimulate a certain degree of investment expenditure and consumption expenditure in the economy. Now, I think that the pass-through to investment expenditure, consumption expenditure, there are other things happening there that sort of quieten the signal of the reducing interest rates. These could be the uncertainty out there, the difficult business climate, the infrastructure, all these structural things that we know we have to deal with in South Africa as well. So just lowering interest rates is going to have an impact, but it could have a much higher impact if we addressed all of these other issues at the same time.
Yeah. All right, let's leave it there, Frank. Thanks so much for your time and just sharing your analysis on the latest move by the SARB. Now, that was Frank Blackmore, lead economist at KPMG South Africa.